Hi, this is Kevin Kerr for Money and Markets TV. For several years now, I've been warning about the risk of hyperinflation to the global economy. I knew that the reckless printing of fiat currency, enormous sovereign debt, overpriced real estate markets, and banks gone wild were a disaster in the making. I said it was only a matter of time before the economic devastation, widespread unemployment, downgraded ratings, foreclosure madness, and political upheaval would rule the day. And I feared that municipalities and even entire countries could eventually default on their debt. Sadly, I'm being proven right. And worse still, we haven't seen anything yet. Inflation has been rising for the past 7 years, most dramatically in precious metals, energy, and food prices. And I believe they still have a lot further to go as the US dollar continues to lose value. The only reason that this trend hasn't been more pronounced is that the euro is performing just as badly. The possibility of default is looming for Greece, Portugal, Ireland, and even Italy and Spain. Ultimately, the very survival of the European Union is at stake, and inflation is a big part of the problem. Here in Estonia, where I live, the government acted responsibly and took huge cuts in order to qualify for the privilege of using the euro. But many other peripheral Eurozone nations spent like drunken sailors, and now they simply can't pay the bill. The result has been 20% surges in inflation since Estonia took on the euro. We feel as though we were invited to a wedding, and it turned out to be a funeral. But while things are bad here in Europe, the US may not be far behind. As Ben Bernanke continues to print fiat currency, the dollar keeps plunging in real and perceived value. The end result could be the loss of its status as the world's reserve currency. OPEC may decide to price oil in gold-backed dinars instead of dollars, and China is likely to further diversify out of US dollars. Of course, we all know about China's failed efforts to get a handle on inflation at home. But what's less understood is that the reason behind this inflation is the Chinese currency's effective peg to the dollar. The dollar is used to price food, oil, and commodities. So a falling dollar equals soaring prices for everyone. So what are consumers supposed to do about these fiat currencies that are falling almost daily and commodities prices that are rising even faster? My answer: embrace inflation. The simple truth is that we have to accept the fact that inflation is here to stay and likely to get a lot worse before it gets better. Sure, some things will fall in price, but the primary staple commodities like energy and food will increase exponentially. To best avoid the negative effects of inflation, consider investing in durable goods or commodities rather than paper money. However, buying actual physical commodities can be too daunting for most investors, and futures and options on futures can carry unlimited risk. So the best way for average investors to capitalize on rising prices may be with commodity exchange traded funds. A few of my favorite ETFs include the PowerShares DB Agriculture Fund, ticker symbol DBA, the Van Eck Market Vectors Global Agribusiness ETF, ticker symbol MOO, and the iPath DJ UBS Agriculture Subindex ETN, ticker symbol JJA. In addition, options on commodity ETFs offer significant leverage, limited risk, and a range of vehicles to trade. So they can magnify your profits even more. I'm showing subscribers in my new Master Trader service how to use them and really take advantage of rising inflation. I'm Kevin Kerr for Money and Markets TV. Thanks for watching.